welcome back to my channel. As the title suggests, this is week 2 of building a portfolio. In this video, I'll be going over a few investments I'm interested in, as well as updating y'all on a new strategy I'm considering employing called the core satellite strategy. This strategy is heavily based on investing in ETFs. But before I delve deeper, I think it would be beneficial for all if I just briefly explain what an ETF is. For those that are already familiar, you can just skip to my description of the core satellite strategy, as well as some of the ETFs I'm considering investing in. So this page represents the main sectors within the market. People's level of awareness and knowledge is going to vary across the different sectors. But let's say, for example, you are particularly interested in the technology sector and believe that in the short term and or in the long term, it's likely going to do well. As a result, like most investors, you're likely going to be investing in some of the top companies in the technology industry, such as the ones that you see here. There are a few ways to go about investing in these companies. One, you can go the more traditional route and buy individual shares of each of these companies. However, this can be very expensive. Some of these companies sell their shares for $1,000+ each. So not only is there a financial expense, but there is also a temporal expense because most people, like myself, will take a long time to buy individual shares. There's another less costly way to invest in all these companies, and that is by buying an ETF. An ETF consists of multiple stocks from different companies. An ETF is created and managed by various investment entities. So for example, a bank may create an ETF for the oil industry. Thus, the ETF is going to consist of stocks from various companies of that oil industry. So therefore, if I buy one share of an ETF for, say, the oil industry, I will then own portions of different oil companies. So as a result, just by owning one ETF, the ETF essentially tracks the market for that industry. Here is an example of an ETF that reflects the technology industry. You can see the top 15 holdings. So an ETF may have hundreds of companies that it invested in. However, in this case, the top 15 holdings are likely going to represent the largest companies within that industry. So just like we mentioned earlier, you have Apple and you have Microsoft. So this ETF allows you to invest in all these top companies just by buying one share of the ETF. You can also invest in ETFs that don't just track one industry, but tracks the entire market. And this is where my plan kind of orients itself around. Alright, so my plan starts off by investing the majority of my money into ETFs that track the entire market. And there's a few reasons why. The main reason is that the average market return for the last 50 years has been about 10%. 10% return is really good. It's higher than the inflation rate, which is 2%, and it's a lot greater than the interest rates banks give on savings accounts. If you look here, it says the S&P 500 is often considered the benchmark measure for annuals. For those that don't know, the S&P 500 is an index that consists of the top 500 companies within the United States. And because they're the top 500, many people say the performance of the S&P 500 is an indicator of the performance of the overall market. Therefore, you don't have to track necessarily the entire market, but you just have to track the S&P 500. Okay, so here represents a graph tracking the overall returns of the S&P 500 for different intervals. 5-year return was a little less than 15%, 10-year return is a little more than 10%, and up till now, it's showed a return of 10.54%. Actually, a lot of the times, the S&P 500 will beat the market. Okay, so this is just a slide to provide you with additional information you may find useful about the S&P 500. For example, the annual return from 2010 to 2019. As you can see that there is some variation on the returns. Just on average, the S&P 500 gives you a little more than 10% a year. You also have the 10 largest companies as well as the distribution of the top 500 companies. So the first ETF I'm going to invest in is called the Vanguard S&P 500 Index. It is $69.07, which is one of the 3 reasons I chose this one. When I did my research, a lot of the other ETFs were pretty expensive. Some were around $400, some were $200. Considering that I'm investing approximately $50 a week and the price is only $69, I thought this should be a good starting ETF. Secondly is the expense ratio. For those that don't know, that is the fee that you pay the management firm to manage that fund. So according to industry standards, 0.8 I believe is within the range that is considered cheap. And finally, after tracking the performance of this ETF, it seems like it does a good job matching the returns of the S&P 500. Okay, so as I mentioned earlier, I'm employing a new strategy called the Core Satellite Strategy. So the Core reflects the ETFs that track the S&P 500. I'm going to dedicate approximately 80% of my money to that. And then the second step of the strategy is to invest in what's called the satellite. Investing in ETFs that solely track the S&P 500 isn't necessarily complicated. Personally, I don't necessarily find it fun. However, I find it a smart maneuver. The second part of the Core Satellite Strategy is what I find most fun. Okay, so the satellite just represents specific industries that you want to invest in. So you can buy an ETF that tracks, say, the oil industry or the automotive industry. There's slightly more risk just because there's less certainty about how that specific industry is going to do. So the satellite strategy allows you to dedicate 10 to 20% to invest in specific industries. My personal approach is that I'm going to invest approximately 70 to 80% in ETFs that track the overall market. Then I'm going to invest approximately 10% into other ETFs that track other industries, and then I'm going to invest the last 10% in individual stocks. Okay, so the satellite that I'm going to be investing in this week, the ETF is called VanEck Vectors Digital Transformation. So this is an ETF that tries to track the digital crypto industry. The reason why I chose this one over other ETFs is that I believe this one differentiates itself because it tries to only include companies that don't actually own companies where their value isn't actually based on ownership of different crypto coins. Instead, its value purely comes from their contributions in developing the technology that supports cryptocurrency. And I believe that this technology is going to be there for a long time. I believe that there's a lot of promise in this technology. And so because I already have large portions of my money invested in coins already, I figured I'd invest in now just technology itself. Alright, so that's the end of the video. I'm sorry if I was a little bit wordy. I'm still working on this, of creating YouTube videos that are concise and has relevant, meaningful information. So bear with me, I'm sure it's going to improve. If you have any comments or thoughts on the ETFs that I chose, or any recommendations on ETFs that you prefer, just leave a comment below. Also, thanks for watching, and stay tuned for next week. If you did like the video, just hit the like and subscribe. Thanks.